Somewhere on the internet right now, there is a market where people are placing real money bets on whether a particular Indian political party will win a state election or whether India's GDP growth will cross a particular threshold this year. And here's the twist, none of this is happening in India. The platforms running these betting markets are based in the US. The traders placing these bets, well, don't know where they are. You see, Indian law doesn't allow us, that is, its own citizens, to participate. And yet, these events being priced, the outcomes being speculated, are all of relevance to India. This is the world of prediction markets. And whether you and I can legally participate in them or not, someone out there is really thinking about us. I'm your host Sandeep Rao, and this is an episode about what prediction markets are, where they came from, the extraordinary intellectual foundation behind them, the billion-dollar battles being fought over their legality, and most importantly, what all of this means for India and for us. Like I always do, let me first explain what prediction markets are. A prediction market is a venue that lets you place a bet on a specific future event, but with one important condition. The event has to have a clear, verifiable outcome. It can't be vague. It can't be open to interpretation. It has to be something where on a particular date in future, the world can look at the result and say, yes, this happened, or no, it didn't. So let's take an example. Suppose you believe India's GDP growth will come in at 6% or more in the coming year. In a prediction market, that gets structured as a simple binary contract. A contract that pays you, for example, 100 rupees if GDP hits 6% or above and pays you nothing if it doesn't. If you are confident in your view, you buy that contract. If someone else thinks GDP will fall short, they are on the other side, they sell it to you betting against you. Now you may ask, how is the opening price of this contract determined? Well, the platform, say Kalshi or Polymarket, looks at all the publicly available information on that question. Historical GDP trends, RBI forecasts, IMF estimates, whatever the consensus is. And based on that, they set a starting price. Think of it like an IPO price set by the platform before trading begins, reflecting everything the world already knows. Let's say the opening price is 50 rupees. From there, the crowd takes over. As with any stock, buyers or sellers, each acting on their own private information and judgment, are expected to act, and eventually the buying and selling pressure finds a balance. Let's say at 63 rupees. Here's the simple math behind the number. The contract pays 100 if you are right. You bought it at 63, your potential profit is 37 rupees. That's 100 minus 63. Your potential loss, if you are wrong, is 63 you put in. One way to read this is that the market is implying a 63% probability that GDP hits the target. How? Because 63 out of a possible 100 rupees payout is simply 63%. The price is the probability expressed in rupees. One more thing worth clarifying. You might wonder, does every contract open at 50, like a coin flip? Not at all. 50 rupees would only be the opening price if the event is genuinely uncertain and nobody has any prior edge on it. If the contract is on something where public information already points strongly in one direction, say a very popular incumbent government contesting an election and they are widely expected to win, the platform might open the contract at 75 rupees or 80 rupees straight away, reflecting the existing consensus. The opening price is always anchored to what the world already knows. What trading does is refine it further, incorporating everything the world is still figuring out. With the conceptual definition and the mechanics out of the way, and before I get into the academic foundations of prediction markets, let me take a step back. You see, betting on future outcomes is not a modern idea. It's not a Wall Street idea either, nor even an American one. It goes much further back. In many ways, it's deeply, deeply human. Think about it. The moment we became capable of imagining the future, of asking what will happen next, the natural logical follow-up was, how confident am I? And the moment two people had different answers to that question, the conditions for a bet were created. You can find traces of this instinct across history. The Greeks wagered on the outcomes of the Olympic Games. The Romans bet on chariot races at the Circus Maximus. In medieval Europe, people speculated on wars, who would win, how long they would last, and even on harvest outcomes. Closer home, we have the Mahabharata. The game of dice between Pandavas and Kauravas is one of the most consequential wagers in Indian mythology. And the reason that story has endured for thousands of years is not just the scale of its consequences, but the emotion behind it. The feeling of being so certain about something that you are willing to stake everything on it. That impulse to put something real behind a belief about the future is deeply, almost uncomfortably human. But here's where it gets interesting. Historically, there has always been a moral lens applied to betting or gambling. For most of human history, it was viewed as a vice, something to be regulated, taxed, banned, or at best, tolerated quietly. The framing was almost always negative. Betting or gambling was associated with greed, excess, and recklessness. So much so that even participating in equity markets is sometimes dismissed as jua in some conservative settings in India. But on the bright side, and over time, that perception has evolved. People have come to recognize the value that capital markets bring to entrepreneurs, to the economy, and to society at large. Markets serve as mechanisms for capital allocation, and when regulated well, they become a net positive. And in many ways, something similar is now beginning to happen with prediction markets. Now over to the intellectual and academic foundations of prediction markets. The story starts in 1945 in the pages of the American Economic Review with a short paper by the Austrian economist Friedrich Hayek. The paper is titled "The Use of Knowledge in Society." I genuinely recommend reading it. It's short and clear and may change how you think about information flows. And by the way, apparently it was this paper which inspired Jimmy Wales to found Wikipedia. Back to Hayek. His argument was simple and quite profound. He believed no central authority, no government, no planning committee, no body of experts can ever collect and process all the information that exists across an economy or a society. Information is always scattered across millions of individual minds in local context, in tacit knowledge that simply cannot be written down or transmitted. A farmer in Vidarbha knows something about cotton that no bureaucrat in Delhi can ever know. Similarly, a trader in Surat knows something about diamond prices that no ministry report can ever capture. But here is where the beauty of the market comes in, Hayek argued. You don't need to collect all that information centrally. Markets can do it for you. Every time someone buys or sells, they are essentially voting with their money, based on what they know, what they believe, and what they've seen on the ground. And the price that emerges from all that trading is a compressed signal of everything everybody knows collectively. Prices, in that sense, are not some random numbers. They embed information within them. Information that is perhaps most honest and most efficient. This idea is the foundational philosophical backbone of every prediction market ever built. The next piece came from Kenneth Arrow, the Nobel Prize-winning American economist in 1953. Arrow introduced a concept called state-contingent security, which sounds complex but is actually quite simple. Imagine a contract that pays you 1 unit of money if it rains in Mumbai on a specific date and pays you nothing if it doesn't. That's a state-contingent security. Its entire value comes from whether a specific future state of the world occurs. Arrow showed mathematically that with a complete set of such contracts, one for every possible future state of the world, you could, in principle, price any uncertainty. You could build a market for literally any question about the future. What he was describing, without using the term, was a framework of sorts of the modern prediction market contract. The third piece comes from Eugene Fama in the 1960s, his efficient market hypothesis. Something I referred to in episode 8 of The Long and the Short, which was about overnight drift. EMH refers to the idea that asset prices already reflect all available public information. When new information arrives, prices adjust immediately, faster than any analyst or any newspaper can. And if that's true for stocks and bonds, there is no reason in principle it couldn't be true for political events or policy outcomes or economic forecasts. By the 1990s, all of these threads were pulled together by one person, Robin Hanson, an economist at George Mason University. Hanson asked, if markets aggregate information better than experts, why don't we deliberately engineer markets to answer specific questions about the future? Not just what will oil prices be in some time in future, but who will win the next US election? Or will this drug get an approval? Or what will India's current account deficit be next year? He called these decision markets, and he went even further. He proposed a governance model called Futarchy. Now this one is super fascinating. Be with me for a moment. The idea was vote on values but bet on beliefs. Now what does that mean? It's a model where we as a nation, through voting, decide the outcomes that we want to achieve, say 10% GDP. That's the values part. Next, we vote for the method or the plan that's most likely to help us achieve that outcome. That's the belief. So instead of politicians deciding policy based on ideology and intuition, prediction markets would estimate which policy is most likely to achieve a desired outcome. And we'd simply implement whatever the market, in this case the nation, prefers. I know it sounds very radical and I really don't know how practical it is, but it definitely got me thinking about the value of prediction markets. Anyways, let's move further. Now, Hanson also made a deeply practical contribution to this model. He invented something called the logarithmic market scoring rule, or LMSR, a mathematical mechanism that ensures a prediction market always has liquidity. Now, without getting into the math, it means a prediction market operator can always offer a price and traders can always buy or sell even when there aren't enough natural buyers and sellers on both sides. What he invented became the engine inside most of the prediction market platforms that exist today, like Polymarket or Kalshi. At this point, I'll take a bit of a detour to tell you about some interesting things which I figured while I was researching about prediction markets. You see, there was an organized presidential election betting market that operated on the New York Curb Exchange, an informal structure with people sitting by the curb and speculating. This was quite common from the 1880s all the way through 1930s. In fact, historical research tells us that they were pretty accurate, correctly calling out 11 out of 15 presidential elections. So what killed them? Well, three things happened. First, scientific polling arrived. George Gallup correctly predicted Roosevelt's 1936 landslide victory when almost everyone else got it wrong, and suddenly there was a new, more respectable way of forecasting elections. Second, anti-gambling sentiment grew among the politically powerful across the US. And third, in New York specifically, they legalized horse race betting in 1939, which gave gamblers a cleaner legal alternative. Next is the story about something called Iowa electronic markets. Robert Fawcett, George Newman, and Forrest Nelson were economists at the University of Iowa. In 1988, they were sitting at a bar in Iowa City, frustrated by how badly polls had performed in the Democratic primaries that year. Experts were overconfident and information was getting lost in the noise. They came up with an interesting idea to build a real money market on the outcome of the presidential election. Not a survey or a poll, a market where people put actual money behind their beliefs and could profit if they are right. And they really built it. With some modest funding and just about 192 initial traders drawn from the university community, they launched the Iowa political stock market. Contracts that paid $1 if Bush won and nothing if he lost, and vice versa. The result? The market predicted George Bush's popular vote share to within 0.2 percentage points. It outperformed virtually every major poll. From that one bar conversation among three economists, the Iowa electronic markets grew into a genuine research institution. In 1992, the US Commodity Futures Trading Commission, the CFTC, which I will come back to many a times later, issued it a no action letter. A formal statement saying, "We see what you're doing. We are not going to shut you down, but keep it small and keep it academic." Investments, therefore, were capped at $500 per person. So, in a way, the proof of concept was there in the academic world at least, that markets could forecast way better than experts and polls. The question was, can you scale this? Turn it into a real financial product, and if so, who would regulate it? Between 1999 and 2013 was this decade-long phase of experimentation. Intrade, launched in 1999 out of Dublin, Ireland, deliberately outside US jurisdiction, became the most famous prediction market in the world. It correctly predicted Saddam Hussein's capture, Obama's 2008 victory, and 49 out of 50 states in 2012. That was about Intrade, which was based out of Dublin, Ireland. I came across another interesting story. In 2003, the Pentagon's research arm DARPA funded a project to use prediction markets to forecast geopolitical instability in the Middle East. When two senators went public calling it a terrorism futures market, the project was cancelled within 48 hours. Back to Intrade, the one in Dublin, the CFTC eventually sued them in 2012, and then in March 2013, the platform collapsed entirely. Not really from regulation, but from a financial scandal involving diverted client funds. Things began to change in 2018 onwards in the prediction markets world. Two MIT graduates, Tariq Mansoor and Luana Lopez Lara, both with backgrounds in quantitative finance, followed a slightly different approach of seeking to get regulated first. They go back and forth with CFTC for 3 years and finally get an approval for what is known today as Kalshi. It was the first fully licensed event contract exchange in the United States. They publicly launched in 2021. Today, Kalshi is valued at $22 billion and both the founders are billionaires, and Luana is the world's youngest self-made woman billionaire. About the same time, Shane Copeland, a 20-year-old New Yorker, took a very different approach. He founded Polymarket, a prediction market which was built on the Polygon blockchain and denominated in USDC stablecoin. CTFC wasn't really happy with it as it didn't fit into the financial regulation. After a bit of a regulatory back and forth with CFTC, Polymarket finally bought over QCX, a CFTC licensed exchange, and got the regulatory standing to operate legally in the US. Today, Polymarket is valued at close to $9 billion. While all this happened, the 2024 presidential elections in the US changed things radically for prediction markets. You see, there were two regulatory battles which were being fought. One was about election contracts. a case that was won by Kalshi against CFTC. Election contracts on licensed, regulated exchanges are now legal in the US for the first time in a century. The second battle was about sports contracts. So there is some sort of a constitutional confrontation going on with this. Some federal versus state issue, and Kalshi has a restraining order at the moment on it. Now, if you have stayed with me till this point, you have every right to ask, what does any of this have to do with India? Quite a bit, actually. If you look up any of these prediction markets today, you will find India-specific events actively listed and traded. State assembly elections, economic data outcomes, even sporting events. All of it being priced in real time on platforms based thousands of miles away in a totally different country. Now, sports betting is not legal in India, and as Indian citizens, we cannot participate on these platforms either. But here is the thing. Information doesn't really respect borders. It never has. What is playing out on these platforms is proxy for some of the most consequential Indian events. The recent state assembly elections actively traded. Indian GDP forecast listed and priced. And this isn't just recreational betting by some curious foreigners. Now think about who is on the other side of these trades. It could be FIIs who have billions of dollars parked in Indian equities and bonds, global macro funds that need to decide, do they go risk on or risk off on India for a given quarter. For them, prediction market prices on Indian events are live signals, real-time intelligence on political continuity, policy direction, and economic momentum. The kind of ground-level information that no Bloomberg terminal can give you. That is what prediction markets enable. And that is why, even if we can't participate, we should absolutely understand them. Now, if your question is, will India ever have its own prediction markets? The honest answer is not anytime soon. Our existing derivatives markets are still maturing. The regulatory frameworks around them are still evolving. Prediction markets would need a far more sophisticated ecosystem than what we have currently in terms of market infrastructure, regulatory clarity, and investor sophistication. But here is the encouraging part. The fact that the American regulatory system is now formally recognizing prediction markets, that a body like the CFTC is actively debating, litigating, and ultimately legitimizing prediction markets, it's a signal that this is no longer a fringe idea. It is becoming a mainstream financial product. And if history is any guide, ideas that get legitimized in the US have a way of eventually finding their footing in the rest of the world, India included. We may not be there yet, but someday, yes. Finally, a word of caution and some bit of critique on the idea of wisdom of the crowds. You see, the logic works well when participants are diverse, independent, and dispersed. But when a large number of ideologically aligned traders dominate the market, you end up amplifying a concentrated view which could be far from reality. This is indeed one of the key limitations. It does not invalidate the whole idea, but at the same time, we should not take prediction market prices as gospel either. So I hope this episode gave you a new lens on how US prediction market space is evolving and what's in it for us here in India. If you are interested in some of the foundational ideas in this episode, I'll share 2 books that help me. One is The Wisdom of Crowds by James Suwecki. This one is a very readable introduction. The second is Super Forecasting: The Art and Science of Prediction by Phil Tetlock and Dan Gardner. They share their findings about what separates accurate forecasters from everyone else, and it's directly relevant to understanding what prediction markets are trying to replicate at scale. That's pretty much it for this episode. Do share your thoughts in the comments. I read them all and I'll do my best to respond. Thank you for watching, and as always, be careful with your capital. See you in the next one.